Greetings, ladies and gentlemen. My name is Mukesh Rajani, and I'm a partner at PwC in the UK. At PwC, I headed the PwC India Business Group, advising British companies going into India and Indian companies coming to the UK. PwC is also established in India, where it's been operating for 125 years, helping our clients enter and navigate through that market. In this session, what I'd like to do is spend about 10 minutes or so talking about India, give you a brief business overview, deal with some of the tax and regulatory issues that you need to be aware of, and some of the issues around getting cash into India and getting those well-earned profits out of India. Doing business in India. India, of course, is not that dissimilar to any of the emerging markets that you can think of. It's different in many ways. There are substantial opportunities available for businesses, but equally there are challenges too. The challenges are in a number of areas, ranging from the cultural issues that you will have heard of, the issues around in selecting a right business partner to do business there, the infrastructure in the country and the difficulties that might potentially pose, the complex regulatory and tax environment there, and more generally, its systems around corporate governance, legal systems, etc. In terms of ease of doing business in India, in the World Bank Index, India stands at 132 out of 185, showing that it is not that straightforward to do business in India at present. Let's take a brief look at the regulatory environment in India. So far as India is concerned, it is relatively open for business now. Most businesses can invest in the country in most sectors that you might wish to engage in. There are few and limited in number which are not open to investment, and some of those are there largely for strategic reasons, including defense, agricultural, and so on. But the broad message is India is open for business, and it is possible to make substantial investments in that territory. It is also possible to secure 100% investments in that territory, although whether you choose to do so or not to do so will depend on your strategic approach to India and whether you need a joint venture partner or not. It is possible to operate in India through various different business types and forms, which I will talk about later. But in principle, there is flexibility in that area. So far as foreign exchange is concerned, India still has some restrictions in foreign exchange, and these are relevant in considering cash in and cash out. And I'll touch upon those later as well. So far as this company law regime is concerned, it is very much modelled on the UK, and the Companies Act 1956 is in place, but this is being modernized at present, and it'll be very soon that we see a new companies bill going through Parliament at the present time. There are a number of other legislative requirements that you need to be aware of. From a tax perspective, which is the focus of this presentation, it's really direct taxes and indirect taxes. From a direct tax point of view, there is a direct tax code that is being revamped at present. And there are a number of indirect taxes that you need to think about in terms of customs duties, excise duties, sales taxes, VAT, and so on. All of these are likely to be swept away as the GST, goods and services tax regime, comes into in India, making life easier from a number of perspectives. So all in all, there is a complex tax regime, but India is committed to simplifying and demystifying that. Entity options. In what form can you establish yourselves in India? Well, there are a number of options that are available to a group. You can set up a company in India, and this can be wholly owned or with a joint venture partner. You can have a branch office in India if you choose to do so. If you have a project, you can have a special project office, and that would be allowed as well. And if all you're doing is acting as a listening post for the moment in India, it's also possible to have a fairly simple liaison office structure that you might wish to operate out of. There's also a recently developed business model in the form of limited liability partnership, which is a new area that has been opened for foreign investors coming in to trade in India. For the most part, most of the groups that we deal with and the companies that we deal with are going to operate in India through a company, and that is where I will focus the next few minutes of my attention. So you formed a company in India. Now you need to capitalize it. what are the typical methods of doing that? Well, in most cases, you will find that money is sent to India in the form of share capital, whether that is ordinary shares or preference shares. That is also fairly common in the UK. The other area that cash is often flowing into India is in the form of debt. You might wish to give loans to your operations. Here, there are a number of regulatory restrictions. If loans are to be made to areas of strategic importance, they will be allowed. In other areas, there are restrictions, and it's something that you need to navigate through carefully. You can, of course, borrow locally if you wish. However, you need to be aware that inflation is high in India, as are their interest rates. So very often, it is a lot more cheaper to borrow funds from overseas sources rather than local sources. But there are regulations to deal with that. From a tax point of view, the tax areas are of course complex. India has a tax rate of roughly 33.9% as corporate tax. That compares to 23% for UK, so that's a clear 10% differential. India also has a dividend distribution tax, which means that every time you pay a dividend or declare a dividend, there's a tax of 17% to be paid, versus 0 in the UK. So all in all, the tax rates are substantial. If you're operating in India as a branch, your effective tax rate would be 43%, compared again to 23% in the UK, a 20% differential. So you can see how it can be expensive to operate as a business in India. India also has capital gains taxes. So as a non-resident, if you sell the shares in an Indian entity or an Indian asset, then there will be capital gains to pay at anything from 0 to 42%. India imposes withholding tax on all sorts of income generated from sources within India and flowing out of India. And I will touch upon that in a few moments. But again, the tax rates can range from 0 to 42 to 43%. What I'll now do is illustrate to you what happens if you make a profit of 100 in India and what is left over to remit to the UK. If you start with a profit of 100, the first thing you'll have to do is pay Indian taxes at the roughly 34%. Once you've done that, under Indian company law, you're required to set aside 10% of your profits as reserves that are not to be distributed. Following that, you can remit the entire proceeds outside India in the form of a dividend with dividend tax payments attached to it. So all in all, a profit of 100 translates into roughly 50 or 51 flowing out to the UK, a tax leakage and a cash trap of 49 to 50%. However, if you were operating as an LLP, which is a recent business model, there are some benefits to be had there, resulting in an effective tax rate of 34% and a cash outflow to the UK of 66%. So business models and the way you operate is quite important so far as India is concerned. I've just explained that India is fairly expensive from a tax point of view, at least relative to the UK. But of course, India does also offer other incentives to investors going there to operate their businesses. The key benefits are really around the SEZs or the special economic zones. If you are to operate in an SEZ unit and establish yourself with a view to exporting, whether it's services or goods, then you can potentially enjoy tax holidays for anything up to 15 years. So that's an important factor to bear in mind when we're going into India. There are also other benefits to be had if you locate yourselves in specific states. Again, a number of tax holidays might be available to you. And finally, those who are in the research and development sector and the scientific research sector, there are specific reliefs available to that sector too, to enhance the business presence in India and encourage innovation in that country. So how do I get cash out of India? We've just talked about getting cash in and paying taxes. But there are a number of different ways that cash can be extracted from India or remitted to the home country. The first one was dividend, which we talked about earlier. You can pay a dividend, but there's a tax of 17%. In addition to dividends, of course, if your business requirements permit this, you can take money out by way of interest on any loans that you have made, any royalties and license fees on the intangible properties that you might have and licensed in, any management charges for the services that the UK company may have rendered, and eventually, of course, on disposal of the shares. In all these areas, there is a withholding tax to be paid in India, and that ranges from 0 to 27% and 42% in some extreme cases. However, the UK has a double tax agreement with India, which means that in practice, if you're able to rely on that agreement, you should be able to limit your withholding taxes in India to a general rate of about 15%. So it's worthwhile considering the tax treaty arrangements with India when you're planning your activities there. When you eventually come to sell your shares in India, as I mentioned earlier, there is a capital gains tax to be paid. And again, you should be considering how you manage that rate, which can be anything from 0 to 42, but in practice ranges from 10 to 20%. Takeaways. So what are the takeaways for today? Clearly, India offers enormous potential and enormous business opportunity. What I would say is that India has high effective tax rate and number of withholding taxes on the income that flows out of the country. It's very important, therefore, that you are aware of the regulatory environment in India and the tax environment in India and plan your way accordingly. It is absolute importance that all companies going into India are looking at the entry plans and exit plans in the overall context to make sure that the after-tax income can be maximized. More detail. There's a lot more detail available to you should you need it. I would urge you to look at the Destination India Guide produced by PwC, which is available on the website both at UK IBC and on the PwC website. That is, of course, a complex question. There's been a lot of comment in the press over the last 2 years about the tax environment in India. And India is going through a significant change in how it approaches tax. Many companies have felt that the Indian approach has been relatively aggressive and the tax rates are relatively high. I think in general that is clearly correct, that has been the experience of most. But what is happening now is that India is introducing a new direct tax code, which will simplify the code and make it easier to interpret and leave less room for any discussion or challenge with the revenue authorities. Of course, what it's also done is introduce a number of anti-avoidance measures which have concerned businesses quite a lot. And there, the Indian government has promised clarity over the application of those legislation, which includes the taxation of indirect transfers, the taxation of Vodafone-type capital gains, and the taxation rules under the general anti-avoidance rule. So the hope is that following the appointment of the committee, which asked the government to moderate these provisions, that there will be some clarity and focus in here and some ease with which they might operate. But there are two bills that are coming through. One is the Companies Act bill, which is currently in the course of Parliament. The current bill that we have in India is the 1956 Companies Act, which is modelled on the UK's own one going back to 1948. So that hasn't been modernised, and that is in the process of being done so, and should be coming through later this year. So I think what we will find is that the UK company will be in a lot more familiar ground when they operate India, given the similarities that there are with the UK and India. So that's one aspect. The second aspect I talked about is clearly the Direct Tax Code bill. There it's all about simplification, but I think more important to overseas businesses and overseas investors is the clarity around the taxation regime and what they mean, so that they have absolute certainty when they craft their investment plans for India and have no surprises later. That's the ultimate goal. It's probably a long way to get there, but I think the process and the journey has probably started. We, of course, already have limited liability partnerships in the UK, and India introduced them a couple of years ago. So there's an alternative form of doing business in India instead of, for example, a company. And we talked about the company, the establishment of a company, and the procedures and the complexities associated with all of that. The limited liability partnership is perhaps a little more simpler to operate than a typical company might be. Its tax rate is currently more favorable, but whether that lasts or not is another matter, is one area. And secondly, I also talked about flexibility of getting cash out, and you might see more flexibility in an LLP regime. So we're already seeing companies looking to adopt an LLP model. It's not available for everything, so it's horses for courses, but it's something that's worth considering. That's a good question. PAN and PAN cards are very important. Typically, any British company which is earning income from India is likely to suffer tax on that, as I explained. And in particular, you have withholding taxes on India. So if, for example, you were taking a royalty or a license fee out of India, the current rate of tax on withholding is 10%, going up to 27% under the new budget. But of course, our treaty with India says that the tax rate should be 15% in most cases, or 0 in some cases. Now, there's a rule in India which says that for you to benefit from the lower rate of tax, you need to have registered yourself for a PAN, a permanent account number, a unique tax identification number. So it's very important from our perspective to make sure that you have that in place if you are to enjoy the lower tax rates that are to be applied by India under our treaty.